The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today is analyst Mickey Mordek. G'day, Mickey.
G'day, Gaurav. Sorry. Sorry, my dog, it just won't leave me alone.
That was just perfectly timed.
That's all right,
Sorry.
Mickey.
I
Woof.
think- I'm hoping he doesn't do it, but because I've tried to give him some food, he's just not leaving me alone.
We just give everyone some warning that Mickey has a little puppy in the house. So expect some random barking occasionally. Sometimes it's a dog, sometimes it's Mickey. You never know.
All right, I'm just gonna open the back door.
Okay, meantime, I'm going to have a chat with Nathan while you're away. Okay?
All right,
Nathan, and by the way, we've also got research director Nathan Bell. Hey, Nathan.
Hi, Gaurav.
I guess that's what happens when you're in lockdown for a couple of days. You start barking up the walls, right?
It's East Bentley, mate. I tell you, it's tough down in Melbourne at the moment.
Is that where he is? Isn't it?
Locked up. Yep.
Sounds like a fancy suburb. We must be paying
it's
Mickey
on the
too
out-
much if he's living in Bentley.
Not too far from the beach.
Oh, nice. He's got a good. All right. Well, this is actually our small cap special, and when Mickey returns, hopefully,
Well, I'm
Sam's
here
dog. Oh, he's
now.
back.
Yeah,
All right.
I'm just lurking in the background.
Okay. Stay there. Stay lurking, and stop barking because we've got our small cap special, Mickey. This is the one everyone's been waiting for. Nathan forced upon us reluctantly, so we've all gone off and bought our most interesting small cap ideas. I think we all got 2 each, right? I hope we have 2 each, right, boys?
Yes.
Yes,
Yeah,
good.
yeah,
Okay, right. So if you're listening to this, you're in for a treat. You got Mickey barking, and you got us you got us spouting out all these small cap ideas from everywhere. Now we'll get right into it. Mickey, why don't you begin, since we don't know when your dog's gonna start up again? What's your
Sorry.
first small cap idea? Hang on, before we get into it, actually, I want to give let's just have a bit of a chat about why someone would invest in small caps. I keep hearing this argument that there's structural inefficiency in the small cap market, that small caps grow into big caps, that small caps are inherently higher growth. Mickey, let's begin with you. What do you make of those ideas? Do you buy them? Do you invest in small caps heavily in your own portfolio?
No, I don't. Well, I mean, it depends how you define a small cap, I guess, because I guess everyone's got different definitions, and so, well, I'd consider, probably like a micro cap would be, something under 100 million. But I mean, depends on how you define it, really. So, I don't know how do you define it. So some people say it's anything under a billion. So. Yeah, I guess it has to be some definition there. So I would say most of the things that I look at would tend to be, things that we can recommend to members, and that would be
200 million or so, I think, is what we tend to work with at II. Anything under 200 million, we tend to let slide unless it's an exceptional idea.
Yeah. And I think also that's just, well, the thing about those businesses that have probably gotten to that size is that they tend to have something to them, and they have some sort of business model. Maybe they have some competitive advantage, something that's working in their favor, and that's helped them get to that point. And I think the smaller you go, the more kind of detritus that there is. Basically, you've got probably more management teams that you don't know, or maybe you just aren't of the caliber. Don't have the governance structures in place. So I guess just having a bigger company means that hopefully that you're fishing in a pond where just the quality is going to be a little bit higher. But there's still plenty of room to grow. For businesses that are less than a billion. So yeah, that's kind of where I would concentrate.
Nathan, what about you? Do you spend a lot of time looking at small caps, and do you recommend for the hordes of people who approach you on the streets and ask you for stock ideas, do you recommend small cap ideas to them?
Look, I think for most of our members who retirees, they're probably just not interested in them. They're particularly interested in dividends normally, but they also want pretty steady businesses. So, they don't want to invest a lot in small caps. The the reason I like them though is because I'm still a while away from retirement, and I guess the most important thing for me about buying small caps is I don't think you just. I think there's an assumption sometimes that just because you're going down to the small end of the market, you're taking on lots and lots more risk, and that's not what it's really about for me. It's about trying to find good quality businesses that have maybe they're not profitable today, but there's a very clear path to profitability. You understand the business model, and what's really important to me is that you find a lot more companies where the person who runs the business has the biggest shareholding in the business. And people are probably sick of hearing me talk about that, but that insider ownership to me is just extremely important, and I think it matters as much in small cap land as it does anywhere because of the risk of being a small business. And I mean, probably to me, the one that members probably most know that is and one I'm associated with at least is a stereotypical uh, stock. I guess I'm looking for is the Nanosonics situation where there's one I read about it from actually Alan Gray wrote about it of all fund managers. I mean, normally
Oh,
they're the
wow.
real,
Okay. Yeah.
highly discounted deep value stuff, and here they had this little tiny stock I'd never heard of, and said it's got a nice little business in um, razor blade model, which we're very familiar with from Cochlear or ResMed or any of these sort of companies. And the thing that really caught my attention was when the chief of marketing at Cochlear came across to be the CEO of Nanosonics, and to me that told me that, there was a real business here. There was, and again, I don't know these people personally, but to give up the top job, marketing job at Cochlear, which would be a pretty good job, it's a very easy sale to sell a cochlear implant. I assume it would pay pretty well, and I'm guessing there'd be a few options in there as well. So to give all that up to take on the Nanosonics role, and given the background of Nanosonics, it actually had been around a long time, but it was just on the cusp of breaking even. So it just had a few of those boxes ticked or about to be ticked that I really look for. And I never expected it was going to go up 10 times as it has, and it's probably gargantuanly overvalued, would be my guess at the moment. But that's the sort of we call it optionality you get with these businesses. You just never know how good they can work out, and you only need one or two of them to do what Nanosonics has done to carry the returns of your whole portfolio, even if you make lots of other mistakes.
Yeah. I think investors sometimes get a bit carried away by the success of the Nanosonics and forget that investing in small caps, um, it's not an automatic. Just because you're buying a small company, there's no guarantee it's one day going to be a large business, and there's no guarantee that it is under the radar, or that no one's discovered it, or that it's mispriced. And I think too many investors approach small caps thinking that they're the only ones looking at these stocks and no one else is. That just is not true. From my experience at small caps, it's a highly inefficient market, but where people who have knowledge know that the companies really, really well. And if you don't know the businesses back to front and inside out, you're the mug at the table. And no one knows that until they're sitting on the stock at 50% down and wondering what went wrong. And that's when it hits you that you didn't know the business as well as you thought you did. I think I find it very hard actually because of the huge information asymmetries in small caps. And I just think that large caps sometimes people forget that just because lots of people cover a stock, it doesn't mean that that stock is particularly well researched or well understood. And me and Johnny always talk about Apple in this regard, because we're both portfolios in our families both own Apple stock, and Apple is the most covered business in the world, the biggest company. Everyone covers it. It's got something like 200 analysts on that stock, and yet it's been structurally mispriced and misunderstood for years and years and years. And I would argue only now is the true value of that business really being appreciated. So the number of analysts covering the stock, the size of the stock, really doesn't tell you anything about how well it's understood or how inefficient the market is. So I think if you're in small caps just because no one else is, you're probably in there for the wrong reasons. I do agree with Nate that the idea in small caps is the same as the idea in big caps, is that you want to uncover great businesses, and you can do that, regardless of business size. That's no cap on whether a business is great or not. So just be careful the reasons you're
When
fishing
we
in the
came
small
out
cap
of,
pond.
sorry, Gaurav, when we came out of the GFC, as we just had model portfolios then, but I remember we had them filled with blue chip stocks because they were just so cheap. I mean,
Yeah, that's
Macquarie
right.
at $20 and, Aristocrat and all the rest of them that picked all the right stocks at the time. And for me, there was just no need to go take extra risk with any small caps because the value in the big blue chips was just so extraordinary. And I'm not sure if I'll ever see valuations like that again in my life as what we saw during the GFC. But it was an extraordinary period, and so it was just risk reward. If you were going to be able to make 4 or 5 times with Macquarie Group or Aristocrat or whatever it was, there was just no need to get involved with the small caps. You got extra safety, if you like, because they were well established businesses, and then you got the dividends as well as they recovered.
And I remember at the time seeing we upgraded ASX for, I think it would have been like $8 or something, $12, something like that. I remember thinking, yeah, look, it all looks good. I know it's a good business, but I want something more exciting. I didn't study and do all this work so I could buy ASX, and it was really hubris and youth. I think that stopped me from buying a great business at a great price. And I think the point I just want to make is that that's a silly thing to do.
I
But
think
with all
too,
that
just
being said,
I mean, when I first recommended CSL, I think it was $33 or $32. I remember thinking if it gets to $40 in the next 2 years, I think this was 2009, that would be a pretty good outcome. Like I wasn't thinking it was going to go to 40, 45 times earnings and grow earnings at, probably 17% a year since then and go to $300. So I think this period has been exceptional too, just the impact of low interest rates has had on these valuations.
that was so I joined about the time that you first recommended CSL, and that was the first stock I bought as a professional stock analyst, and I still hold it to this day. Haven't sold it. Haven't sold a single share. I ought to buy you a coffee or something.
The pain of the salt in the wound for the person who never bought any. And it was exactly
Uh,
that same thing you said about ASX, right? I just
yeah,
didn't see the upside that big. The business just got better and better as it got bigger.
yeah.
Well, this is the thing. This is like what I'm coming to a conclusion that I'm coming to is we also forget businesses in Australia look big when they get a $10 billion market cap, but by global standards now, that's actually not even that big. And it's so easy for businesses to go global now as well.
Mm,
And this is like people were looking at Afterpay going, and I don't think. Well, I mean, we definitely have mixed views on Afterpay. Maybe
mm.
that's a topic for another
It is a
discussion.
topic. We've had a lot of discussion about this internally. Yes.
um, but uh, but yeah, people looking at that going, oh, it's a 3, 4, $5 billion business. That's ridiculous. But is it? I mean, by global standards, that's a pretty small business. And if you can go global and take your business global, then and you've got Amazon, for example, still growing. This is one of the biggest companies in the world, still growing at really fast rate. So just goes to show that whole notion of trees don't grow to the sky. Well, but they can grow really fast for a really long time.
Yeah. It's
Mm,
interesting the experience you've had, Mickey, because I came in to Intelligent Investment in 2006, and generally the broader lesson you learnt from Australian companies going overseas was they
yeah. Yeah.
usually failed, and so it was really you're always very skeptical of a
Mm,
company that went overseas, but you've got to really be careful about making those broad assumptions because the healthcare industry is a great one. We have all the number one players basically in some of those industries, and they're extremely profitable, and they just continue to grow at rapid rates. And also the other thing that's changed in more recent times is just the digital nature of the new businesses means that despite their gargantuan size, you can include Chinese company Tencent, for example, the growth rates have actually got faster if they've
Mm.
just got massive companies, and we're just never used to that. It's always supposedly the bigger you get, the lower the returns and the lower the growth, but that just hasn't been the case lately.
mm.
Mm.
Yeah. I mean, it also just makes you think about the types of companies that you invest in. Like if a business can't go after a big market or it can't go global, then you're probably, I don't know, maybe that explains why there's such a big disparity in terms of valuations, because it's just like the prize is so much bigger for some of these companies that aren't they? Maybe that's where but I guess everyone's thinking like that as well. So I
Well,
don't know.
let's get to the prize now, Jens. Let's get to the prize now. Mickey, after saying I don't know, let's begin with you. We've got 2 small caps each, so we'll spend a bit of time on each one, but not too long, maybe just a couple of minutes on each one.
Yeah,
What do you have
yeah.
for us, Mick?
Well, I definitely don't want to spend too long on either of mine because I don't really know that much about them.
Oh, well, by all means, bring it
But
on.
Perfect.
but so these are definitely not recommendations, and I just emphasize them. Kind of, these are just small personal positions for myself. It's kind of more of just a wait and see what happens type of positions. But so the first one would be PKS. So it's a tiny business. I think it's about a $33 million market cap. And basically,
what's the stock code, Mickey?
PKS.
Right. Okay.
Yeah. As you'd expect, funnily enough. So, so Pacific Knowledge Systems. So this was a business that basically sells software to hospitals. And so obviously hospitals have a need for, greater efficiency and reducing the workload of, clinical staff, and getting decisions right, basically. So they've got this product called Ripple Down, and that automates the human, decision-making process in lots of scenarios. So I guess it just removes bias and it removes error. It increases efficiency. Basically throughout these healthcare organizations. So that's pretty much what the software does. There was a recent merger with a company called Pavilion Health, which I think from everything I've read is a complementary product suite. So it just helps, I guess, having those conversations with those organizations. The retention is basically 100% based on the prospectus, and they've been winning quite a few clients as well. So, and I think the most important thing here is, I haven't used the product. I haven't spoken to any customers that have used the product, but so this is a very small position for me, but it's trading at a very reasonable price. There is one broker who covers it, and they're expecting 2.5 cents of earnings per share in 2022. And so with a 16-cent share price at the moment for a software as a service business, you can see plenty of upside if the market starts to acknowledge it or starts to look at it a little bit differently. So yeah, I would say it's very speculative. But yeah, I mean it's pretty cheap as well, particularly for a software business with these kinds of stats. So
What problem do they solve for the hospital, Mickey? Do you know?
well, so I think it's a decision making software system. So it basically you put in rules and you say, so if this happens, then do this, or if the patient presents with this, then do this, or basically it's a rule and decision making software system, and you can write in whatever rules that you want, basically. So you get a more standardized approach, I guess, to care. And yeah, so I guess that's useful. It's a pretty simple piece of software, but it seems to do the job. And like I said, retention's been pretty good. So they're in lots of different countries as well. So so we'll just have to see how that pans out. But I think it's got some good ingredients. There's things to like there. So
Is it 10% of the Mordek portfolio?
no, this is a 1% position. So
Okay.
that tells you basically how much I know about it and how comfortable I am with it.
Dog
Sorry,
doesn't like it.
Yeah, it doesn't
Playing
like
the short case.
Have you
to
heard of
be
this?
honest, it's probably more compelling than my bull case. So
Have you heard of this, Nathan? Have you heard this one before?
No, I haven't.
Mickey mentioned it to me, but he's also always mentioning some harebrained stock of all sorts of sizes. But I did have a quick look at this, and it is interesting. They took on this other business and bought it for a really, really cheap price. And that company brings a lot of cash flow to the company, so it kind of removes a lot of the cap raising risk and financing risk that the company would have had without it. And as a
Yeah.
joint business, they seem to be much better placed now to sell their software. I think sometimes with software businesses, people forget that actually the sales function is really important, just as important as the engineering function behind the software engineering function behind the scenes. And to build out your sales team and actually get software installed is a quite a difficult task that requires a lot of resources. So to me, it looks as though the merged PKS now is able to harness some of those resources to get out and actually sell some software. So yeah, it's a nice one, Mickey. Thanks for
Yeah.
mentioning it.
Well, yeah, and I guess so. I guess the other thing was just the price. So, because if you look at how, like the cash flow that it's meant to throw off, according to this broker, you're looking at potentially 2.5 million, two
Hmm.
and a half million free cash flow. So, with that, most software businesses now are trading at what 40, 50 times free cash flow. So, maybe 1,000 times free cash flow. I mean, this could be a $2 billion business by tomorrow.
Cue
Of course
the
not.
dog barking.
But yeah. So I think it's relatively cheap, but obviously not a recommendation to anybody, and definitely don't.
All right,
Suggest you do your own research.
let's do one at a time. Nath, why don't you pull one out as well?
Okay, so the first one I'll do is Moelis. So I just declare up front that I own Moelis, and I also own Smartpay, which we'll talk about in a few minutes.
Spoiler alert:
And
we're supposed to keep it a surprise,
yeah, I
Mickey.
know, but I couldn't be bothered mentioning it again.
Okay.
So I get it all out at once. So bear in mind, I bought Moelis at back in must be March or April when the market was way down, and so the investment case is sort of assumed that I'm buying it at the time. So the share price got right down to $1.26, I think was the bottom. Now that was down from nearly $7 not all that long ago. And when it was priced at $7, it was expected to do about 30 cents in earnings per share. So not a crazy valuation by 2019-20 standards. Moelis is essentially like a small Macquarie group, and it's basically a home for people that have worked, just slogging out the hours at UBS or the other big investment banks, who actually want to come and work for a smaller firm and actually have a lot of equity in the business. So that's the reason why I haven't recommended it. It's just there's a big internal shareholding from the people who work in the business, and it makes it extraordinarily illiquid and just too small for us. And so I really love that part of it. This is people who are highly motivated, very smart, who have had experience in investment banks before, who really know what they're doing and have great networks. And people I've spoken to have talked about the culture in there, where often you get, I guess, ridiculed if you leave before midnight. So this is not a place that I have the energy to work in anymore, but they regularly work till 1 or 2 in the morning. These are people who are highly motivated and highly incentivized because of the shareholding in the business. And so I really like that. And that's really what's made Macquarie succeed over the years. And this is just a much smaller version. It's in a much more embryonic phase, in the sense that when Macquarie came out of the GFC, it had to essentially shut down all those satellite businesses that had been raking in fees, and essentially they became a fund manager. And it worked out extraordinarily well, which is the reason it went from $20 to, I think it was 155 or something over the next decade. And my view was that Moelis was already starting to do that. They were starting to build their funds management business, and that's a business that works really, really well. If you look around the world and you see why Goldman Sachs has essentially failed since the GFC, and why companies like Brookfield have become the best known entities in the financial space overseas, it's because of that funds management approach and not just relying on corporate activity, which Moelis still does some. And you probably see on the Fin Review they've organised a few deals recently, which is good news. So the way I was thinking about this business was that I really like the culture, uh, and I like the fact that the people who are running the business who are the biggest investors in it, and the share price had fallen, I think, from top to bottom about 85%. And it also had cash to invest. So in the same way that I thought that 360 Capital was perfectly positioned for a big downturn and would be able to go and buy all these distressed assets, which would produce incredible returns over the next cycle. Um, Moelis was similarly positioned with cash ready to go. So the fall, the 85% fall in the stock didn't make a lot of sense for a start. But you're starting at such a low position, and let's assume it was going to do 30 cents per share this year had we had no COVID. My guess is if this business is successful, then why can't it do 50 cents or 60 or 70 cents per share over the next 5, 6, 7 years as the funds management business grows? And you put that on 20 times earnings, and you're up into $12 or $13 a share. Now that's obviously the bull case, but I just thought you're well covered on the downside because the share price has fallen so far, and there's a really big bull case that we've already seen work out for Macquarie. So if it follows the same playbook, then this could be another big winner over the next decade. So that was basically it.
Hey, Nath,
Yeah.
I've read interviews with the founder, Ken Moelis, before, and he's been very clear that he wanted to build a business different from your typical Wall Street bank, and culture has always been really important to him. But what's the relation? But I think Moelis is also listed on the New York Stock Exchange as well, if I'm not mistaken. Do you know about the relationship between that American listed entity and the Australian listed one and the involvement of the founder?
Yep. So this is, I don't actually know exactly the background, but I'm guessing this is how it happened, was that Ken Moelis is quite famous for winning because Moelis in the US, I think, is fairly small compared to the Goldman Sachs
Mm.
and things of the world. And he ended up winning I think was it the Aramco, the big Saudi Arabian
Oh,
oil
did he?
company. Like he
Okay.
won the corporate gig for that, which was just an astounding win
Yeah.
for such a small firm. I think I've got that right. And so that really put him on the map. And I don't know when, it must have been a fair while ago, but he must have decided to have an Australian arm and they seeded the business. So that's another reason why the stock's so illiquid, is because Moelis US owns I think it was about 30% of the shares. So
I see. Okay.
again, I haven't looked at the numbers for a while, but I think it was something like 60% of the shares were owned by either US Moelis and the people who work in the business in Australia. So again, that's why it's so illiquid. So that's the relationship. But I believe that the US Moelis is starting to reduce its investment. I don't know whether it's going to pull the whole thing out, but I can't remember what the reason was, but basically I expect over the next 5 years or whatever, then US Moelis won't be anywhere near as large a shareholder, if a shareholder at all. So it'll be quite an independent Australian business, which is how it should be.
Right. Okay. I have
So
heard
does that
also.
mean that they can compete against each other at that point, or?
Oh,
I'm not sure, but the Australian firm really does stick to its knitting in Australia. The one thing that worries me a little bit is that it's trying to grow, and I think it's been reasonably successful from a very small base in growing the Chinese wealth part of its business, in the sense
yeah,
that
that's what
it's
I was going
opened
to
an
mention.
office in, I
Mm.
think it's Beijing or Shanghai maybe, and they've actually put a couple more people in there recently, and
Mm.
they're just getting Chinese investors to invest in their funds or do deals for them in Australia. It's not it's not the be all and end all if it doesn't work out or something goes wrong, but just the Chinese tensions with Australia and everyone around the world makes me a little bit nervous for any company that's got a lot of Chinese exposure.
Yeah, a friend of mine who works for an American hedge fund met up with him recently, and he was telling me that that Moelis in Australia have cultivated that they've cornered the market for Chinese potential migrants into Australia who have to come to Australia with. There's a rule where you have to pour in a couple of $1 million of investment to get to gain your some special visa, and Moelis has become apparently the vehicle of choice for a lot of migrants wanting to apply for that visa application. And so he was saying it's actually a really good niche for Moelis because there's a continual inflow of funds all the time, and they tend to be very, very sticky because they can't just pull that money out because it needs to remain invested in Australia, and because they don't have the investors don't have any other ties to Australia. They don't really have anywhere else to put that money. So he was pretty glowing about how that that part of the business has grown, and talking about how sticky that customer base really was. And that,
That's
for me, it also just highlights just how entrepreneurial this business is. They've gone out and built this little niche that probably no one else has really thought about or looked at. So I was impressed.
That's what I like about the fact they've got money now to invest. It's unfortunately that asset prices have recovered so much across the board, but that may not be always the case. But just that, and Macquarie's done this too, right? They've got smart people and they've got money, so they go and find a niche and then they just put all the money into it and back them in, and they do
Mm,
really well. And Moelis is much smaller, so it doesn't need anywhere to put anywhere near as much money to work as the Macquarie Group, so that should be very beneficial for them. The Chinese link too is as long as things don't deteriorate too much, there's always
mm,
Australia is always going to be a great destination. I would have thought for rich Chinese people who are trying to get more of their money out of the country. There's
mm,
rule of law in Australia. Your money's very well protected. Good regulations. Although I'll complain about bank regulations any day you like. But that aside, um, you know, globally, it's a very safe place to put your money, and it's a great place to live as well.
agreed. I think the dog agrees as well.
Strong buy, I thought he said.
Yeah, I thought I got that too. Yeah, nice one. All right. So my first idea is Experience Co, which is a business I flirted with kind of mentioning in the newsletter, but it's very small. So it's a $60 million business, and it's had a really checkered history. So when it was listed, Experience Co was really mostly a skydiving business. So they actually there's only two main skydiving companies that operate along the East Coast, and um, Experience Co owns one of those two, the larger one. So they have a really large market share in the skydiving market. And I think they also listed with a far north Queensland business that operated tours to the Great Barrier Reef and sort of ancillary tourist services that come with people visiting the reef. So it listed with those two planks, and then it went on this crazy acquisition binge where it just bought every kind of tourist business you can imagine. Ballooning, kayaking, all these other kind of things. It just bought everything, and of course, so that acquisition binge came to an end after too much debt became a problem, and the whole business imploded. It did a dilutive cap raising. Management got cleaned out. There's now new management in place, and they've got, I think, a really interesting recovery plan for the company. They're selling off most of the rubbish that the former management bought, and they're trying to trim the business back to its core of skydiving. But they actually think that they're trying to improve it beyond that as well. So in the previous model, the company actually owned a lot of its fixed assets. So it's actually owned the planes, it owned the boats, and it owned the aircraft and the balloons that it used for ballooning. It owned all its assets. So it was a really asset-heavy business, and that meant it just had to get this constant stream of tourists popping in. And if it didn't get utilization rates high, the profitability of the business was really poor. So one of the reasons it got in trouble was just because the bushfires, drought. For some reason, tourists stopped coming to far north Queensland for a couple of years, and tourist numbers fell. When you're operating this really asset-heavy business model, you get into trouble really quick, and your debt can be a problem fast, and that's what happened. So the company now is actually in the process of selling off all those heavy assets. So they're selling off their planes, and they're selling off. They've already sold off a lot of their boats. They've sold off their fixed-wing aircraft, and they've got some land holdings, which I think they've held on to for now, but they're considering selling those as well. So it's a really asset-rich business. And once they sell off those assets, not only do they remove the debt burden, so the debts come all the way down, and I don't think this is a business where debt is a huge problem anymore. But once you remove that, you actually change your business model. Instead of having a really high fixed cost, you can operate on a variable cost basis. So that means when the tourist season is really big, you can go out and hire more planes and cater for those tourists. And when it's small, your base flexes, and you don't actually lose as much money in a low season. And fortunately, it did this just before coronavirus, as in a response to the bushfire haze, where tourists stopped coming to Australia. So it had to act then. So it's been relatively well prepared for COVID. I mean, shares have been smashed because there's no inbound tourism at all. But the business model has survived because they've got this now flexible cost base, and there's still further to go. The business still has a pretty large asset base that it's yet to sell, and the shares have been completely smashed, as you expect for a sort of a business at the coal-faced end of the tourist market. It shares currently trade for about 10 cents, and it's got 16 cents of hard assets, and these assets should convert to cash pretty easily. There is always a market for planes and land, so I'm expecting that the company should be able to sell its remaining assets. The new business model will mean that it's a lot more resilient. And when you think about the actual quality of the business, skydiving actually offers really good returns on capital. They earn 25% EBITDA margins on skydiving. Very hard to compete because you can't just go and open a skydiving shop tomorrow. That really long history and legacy of pushing people out of a plane and making sure they don't die is really important. People care about the experience you've got when you're doing a risky activity, and so the reputation is really important. And I think there's also an advantage in being large. You can actually hook up with tour operators and big larger travel companies. You can actually embed with them and get and use them as an acquisition funnel in a way you can't really do as a smaller operator. So I actually think the business is capable of earning very good returns on capital, even better now that a lot of the assets have been shed, and you can buy it at a really cheap price. I think the caveat here is that it's going to be probably 2 years before we end up with a normal tourist season, and until then, yeah, I don't think you're going to see much in the way of return. So it's one for the patient, but it is interesting. I haven't bought it myself, but I have been looking at it and thinking about it. So
Hmm.
um,
So
there it
I
is.
own this Gorav, and
Do you
I think
own it? I didn't realize you owned it.
yeah,
Okay.
no, I own it. So I think this is potentially a 5 or 6 bagger in the bull case. But I
Yeah,
think
I agree with that.
but you're just not going to get those huge earnings. When I say huge earnings, you're not going to get back to 2019 earnings. Probably my guess is for at least 3 to 4 years.
Yep.
Just 'cause I think the international stuff's going to be very slow after what we're going through, and that's even assuming we get people back on planes around the world at some point next couple of years. But uh, the other thing I'd say is at the moment it's burning through $1 million a month, and it's in a good financial position for the next sort of 12 to 18 months. But if
Mm,
the recovery it takes longer than that, then my guess is then it has to raise capital, which will reduce some of the definitely some of that upside. But what would be what I was really excited about was Queensland, at least temporarily, reopened its borders because if you can go to the company's website and see where its locations are, and most of them are in Queensland, as you'd probably expect. And once we get, Queensland's basically about just one of the very few places Australians are going to be travelling to over the next couple of years for a holiday. And I'm guessing after this COVID situation, there'll be plenty of people who want to throw themselves out of planes for the fun of it. And if we can at least just get those, they've already reopened some of their uh, locations in Australia and New Zealand, but if they can get them all reopened and at least covering their fixed costs, and if it's just breaking even, at least it's bringing money in, the
mhm.
equipment's being used, the business is up and running, and then you don't have to worry about the debt situation or the financial position of the business. And then once the overseas tourists start coming, then you're going to see a massive jump in the profits at that point, in the profit margins. And my guess is the profit margins. So if you look at the 2019 earnings and the underlying earnings, at least because there's a lot of write-offs in there, but just on the airplane stuff, then I assume my guess is the margins are going to be even higher than that in a few years. Let's say they get back to the same number of people jumping out because they've just taken a hatchet to costs, and so that's and
Although
probably
they
a lot
will
of the
have to
stuff's
include
depreciated.
they'll have to include, yeah, you're right. So you won't deal with the depreciation, but you do have to include leases for equipment now.
Yep. So I think the margins will be higher, and then I think there's going to be less competition as well,
Yeah, I think that's a
um,
big point. Yep.
which means they can go and open up new locations without any competition. So in an ultra bull case, this is it sounds silly to say, but it's possibly a 7 or 8 bagger, but it's going to take 4 or 5 years, I would expect to see that, and you've got to go through uh, the valley of death over the next 12 or 18 months. And that's really why the share price is where it is, because no one knows how long it's going to be before they can reopen their locations and we get past this COVID mess.
Yeah,
So
and
it's
you
a
make a
guaranteed 8 burger.
Not
well,
guaranteed.
It's either a zero or a sort of a yeah. I had sort of 5 to 7 bagger as well, but I think a zero is a possibility in this business because they have been pretty successful at selling assets and they've still got some left to sell. But the fact that the asset sale program has slowed down so considerably might tell you that they're having a bit of trouble selling some of their kit at the moment. And I think they still need to do that to maintain the balance sheet. But
I think we'll have a better idea of things come summer, because I assume
yes,
that's when
yes.
most people are going to be heading to Queensland for their Christmas holidays and doing these sort of adventurous things. Same with New Zealand, and they'll be the warmer months. And there's obviously a lot of talk about COVID being not as bad in the summer months, although that seems to be not the case in Texas and other places in the US at the moment. So, but I think at least just as far as how we're dealing with it and what the future looks like, I think we'll have a really good idea in the next 4 or 5, maybe 6 months.
And it's worth noting also that I think about 15% from memory. I have to check, but there's a decent insider ownership stake here, which I think is really important with these businesses that could go either way. You know, sometimes a small number of decisions can actually impact the very future, the very survival of the company, and it's comforting to know that the people making those decisions have a big financial incentive to make the right ones.
Yeah, I guess
So
the main risk, I think, is if the COVID stuff impacts the business for longer than we hope,
yeah,
then because the share price is so low, it won't make a lot of sense at that point to raise capital from existing shareholders. It'll probably take someone to come in and just take a big stake in the business to get it through another 12 or 18 months, and that way we could actually be highly diluted.
I would expect that to happen. Yes, so I would say if that should happen, the person would get the stock for sort of 2 cents or so. Very hard
I'm
to
sure
recover
the
when
current
that happens.
new CEO though will be doing everything he can to avoid that, because whatever payments he's going to get are
Hmm.
probably going to struggle under that scenario. Can't imagine any big bonuses getting paid for doing something like that.
All right, let's carry on. Mickey, what's your second stock?
Yeah, well, I'll keep this one relatively quick. It's another very small position for myself. It's a company called Adveritas, and so this company,
Give us the code, or should I probably give code? So experience code,
sure.
by the way, is EXP. What's your company code, Mickey?
AV1.
Okay.
Yeah. So Adveritas has a software suite that detects fraud on marketing campaigns, basically. So if you're a company and you've got to advertise via Google, or you've got apps in the Play Store, or in the iPhone Apple Store, there's a recurrent problem, obviously, with fake clicks, and also with fake downloads, fake impressions on your website. So dealing with that as a marketer is really challenging, because it gives you the wrong picture of what's actually going on. Also, it actually inflates your expenses as well. And so this software, basically, there's an algorithm that detects, even before that somebody has clicked on a link, how likely it is to actually be fake. And it's quite accurate based on what they say about the product. So obviously, if it works, it's potentially an enormous market. So it is obviously a very early stage business, and there's no profits yet. It is making revenue. It does have some customers. I think it's got Jumbo actually as one customer that's signed on with them. So I guess there's a few other things going on here. Mark McConnell, who's the fellow that was behind Citadel, so he's a director on this company, and basically, as they've been raising money, he's pretty much been chipping in at each stage along the way, as has the CEO, Matthew Ratty. So you're seeing a lot of insider buying at each successive stage of capital raising. And realistically, this isn't actually a business that should even be listed. This is probably a business that should be, backed by venture capital or something like that. It should still be private. But it's the thing is, it is listed, so they're kind of having to keep raising capital, and that's what's really hurting the share price at the moment. But it's really encouraging just to see those insiders keep on buying and going after the opportunity. So, yeah, it's not a value stock. It's not. It doesn't have earnings. And again, it's one of those ones where I can't personally vouch for the product, but if it works, then it could potentially be quite big. And having a small position, I don't mind really if it goes to zero. I'm happy to just see what happens. It also stops me from playing around with bigger positions in my portfolio that I don't want to touch. So, yeah.
Do you know this one, Nathan?
I do not.
No, I've never heard of this one either, so I don't have too much to add. Except I will add that sometimes the sales process for security type software tends to go through the CTO in an organization. And I remember having a conversation once with a CTO, and he was saying that we just get bombarded with all these security, safety, anti-hacking software providers all the time, and it's really hard. We can't really test the veracity of every single piece of software that we get bombarded with. And I think sometimes these type of security-based software, I mean, we know everyone needs them, but it's actually really hard to get embedded with a business because everyone's got their own idea about how to make something secure, and there's lots of solutions to the same problem. And getting access through that CTO is really, I think, proves to be difficult. I think that's why we've seen so many cyber security type businesses just not do all that well. I think the largest one in Australia is still like a $30 million business or something. The largest cybersecurity firm is a tiny, tiny business. And I think that speaks volumes about how hard it is to actually break in.
Yeah. I don't know if this is a cybersecurity
Yeah,
business
right.
so
It's
much
not.
as
It's not really a
yeah.
cybersecurity thing, but yeah, I think that
But
again,
yeah,
that sales route would be difficult.
yeah. No, for sure. I think it's always hard to get traction, and
But if you can get
you.
it, then you're set.
Well, yeah.
Is
So
this
yeah.
another? Is this another 10% position?
No, it's a tiny position. It's very speculative, and once again, absolutely would not recommend it to anybody. So,
I think the dog agrees. I could hear him whining away.
turns out he was just hungry. He's
Mm.
been pretty quiet for the last 5 minutes. So, just have to keep feeding him. That'll
Like his owner.
running out of food,
Yeah.
like his owner.
All right, Nath. Nath, what do you got next?
Yeah, so my second stock is Smartpay. As I said, I do own it. And
Mm.
the original investment case for this, going back, it was late last year now, it was early this year, but the company has basically what it does in Australia is it sells terminals. So if you go into a retailer and just like the same terminals you'll see at a Coles or anywhere else, and you just put your card up to. It sells those terminals, and it offers the retailer a better price than what you can get through the bank. So that's one advantage. And the other thing it's done is it's changed its business model, so it doesn't just get a fee every time the terminal gets used, but it gets a clip of the sales as well. So to me, that's a really outstanding business model if it works. Now it's the Australian business. When I say it's fledgling, like it's really almost day one for that business. So it's growing from, I think it's only grown from 2 million to 9 million or something recently. So it shows you how new the business is. And the deal was, I think it must have been late last year. The share price had just been sitting there at 20 cents for ages. And then it made an announcement that it was selling its New Zealand business, which was much more mature, for 20 cents. Basically, the entire market cap of at the time of the stock was going to come back to you in the form of a dividend. And then and they're going to take some more of the proceeds that weren't paid out as a dividend to support the Australian business, which they obviously see a huge opportunity in. So there's a couple of things I loved here. One, the CEO's built and sold a $500 million business before, so I think he knows what he's doing. Two, I just loved. I don't think I've ever seen anything like this where a business or a board or chief executive has been willing to get rid of a existing business and put it all into such a uh, early phase investment in another business. It just shows the absolute commitment that you need to for these businesses to win over the long term. So I really love that. And the second thing was it was just it's like once that 20 cents was declared in the dividend, and that sold the New Zealand business. Uh, it suggested that the stock was very cheap if the Australian business, I mean, if the Australian business does well, it was going to be worth way, way, way more than the New Zealand business. So potentially, if things work out, if the bull case works out, you're buying this thing very cheaply. Now, what happened was the New Zealand regulatory body asked for more information in, I think it was March, maybe it was April, and there was a cut-off date for, I think it was Vodafone were buying the New Zealand business for them to walk away from the deal. And the New Zealand Regulatory Commission asked for an extra week, I think it was, or 2 weeks. And that just happened to be the time that Vodafone could walk away from the deal, which they did. And then um, Smartpay, which had already got signed off from shareholders that they could push forward with the deal and pay the dividend and whatnot. The regulatory approval came, but it just came about 10 days too late. And so at the moment, they still own the New Zealand business, but I still expect they're going to sell it. It's just a matter of when, in my view, and for how much. And in the meantime, to support the Australian business, they raised $2 million in a rights issue that was oversubscribed by, I think they raised 2 million, but they got applications for 12, which made perfect sense because the share price was 60 something cents and the rights issue was done at 41 cents. So it was just free money, if you like. And that's where the business sits today. So it's very small. It's in a competitive space, and there's lots of other companies like Tyro and Afterpay and whatever, all part of this new fintech, and not necessarily doing the terminals, but all trying to look at that point of sale and how to clip the ticket best. But I just think it's a really interesting stock, and it's I'm hopefully going to be a long-term holder for it.
Yeah, by the time you're listening to this, we've probably published my review of Tyro. And if we haven't, then spoilers. But Tyro is the largest non-bank participant in this market, so it's a very similar business model. And these require a huge amount of scale, but geez, once you get them going, they can be remarkably profitable with really good economics behind them. But I'm stunned by how much fixed costs and scale is needed to actually get the economics to work. So I do wonder whether the Australian business will ever really be profitable. Just looking at how long it's taken Tyro to be profitable, how many customers, how much transaction volume they've had to run through. Their OPEX is about 100 million for Tyro a year. And you just need a very large processing volume to support such a large cost base. So SmartPay is a big task ahead of them, but I agree with what you said about management. I think they owned about 50% of the market. They're the largest provider in New Zealand, and they owned a huge part of the market. So they know how to go out and capture merchants, although they did it with a business model that wasn't as good as the new model. So they do have that history of doing it before. Yeah, interesting idea. They do, and the valuation is really attractive at the moment, far more attractive than Tyro. I might add. Mickey, what do you reckon? Have you seen this one before?
Yeah, I've had a look at it. Not in the same detail as Nathan has, and I can see the case for it, for sure. So I don't own it personally, but I can see why you would. So
does the dog want to chime in? What does he reckon? He's quiet on this one. Oh,
don't
know what that
tempt
means.
fate.
He's the Charlie Munger of the dog world. He has nothing to add.
But when he does, we all stop and listen, right?
I think we should just have a pets episode. We all bring on a pet or something, just to... No? Okay, all right. We won't do that.
That would mean bringing on my 3-year-old, and we do not want that.
Okay.
His favorite word at the moment is poo, so it would be a mistake. Let's do my last stock. So I was going to mention it's a business I've owned in the past. I don't own now, but it's gotten cheap and attractive once again. It's called GR Engineering. And, I've been quite scathing of mining services businesses, and I generally think they are among the lousiest business models you can have on the ASX. They're capital intensive, they're cyclical, they're competitive. And as they grow, they suck in debt, and eventually all that all that growth disappears, and they either implode or they start releasing a lot of cash. And you have to be able to pick which ones won't implode to do well from this sector. But GR Engineering is a little bit different. It's run by four guys, four founders who collectively, well, all the insiders own about 45% of the stock. And the four founders have actually started, this is their second go at doing a mining services business. And both times they've specialized in building mineral processing plants. Now, mineral processing plants are a vital piece of infrastructure for any mine. It's actually the key piece of equipment that monetizes dirt into something valuable. So when you think about a mine, you've got a couple of key processes going on there. You have to actually dig ore out of the ground. You have to turn that ore into something usable. Then you have to get that usable, saleable ore to where it needs to go. All those three parts are quite important, but the key part really is that processing. The processing is what turns dirt into something useful. And the technical challenges and cost challenges of doing that are quite difficult. And having a business that has done this for a very long time and they have a tremendous record. I was looking at some of the past projects they've done. It's a who's who of great projects in Australia. Every large miner has used them. Their equipment is on some of the most famous mine sites and gold mines and copper mines in the country. So technically, they're very, very strong. Um, I bought this a couple of years ago and sold it and made really strong returns. And I caution that is the idea here. This is not a business you buy, sit and hold on and watch it compound for years. This is a cyclical stock where you buy when it's not so good and you sell when things are looking good again. So why is it cheap now? Well, it's cheap now because one of the byproducts of selling mineral processing plants to mines is that you're often selling to new mine developments, often new miners. And by the time you've built your plant, there's no guarantee that the customer's going to be there to pay for it. And that's what's happened to them. They've had a couple of projects where they haven't been able to collect on. And there's been a bit of dispute with legal intervention required. And that's happened over a couple of projects now. And so the shares have been hammered. Results don't look great at the moment. But fundamentally, this is a really strong business that knows how to do what it's doing, and it's got a really good track record of doing it. The reason why now is an interesting time also is because a lot of gold miners are now sitting on gigantic free cash flows. Some of these free cash flow yields are sort of 20% on gold miners. Now, we're not in the game. We've written in the past about why we don't recommend gold miners. We're not going to do that now. But one way to take advantage of that is a business like GR Engineering, because they build processing plants. And once gold miners have cash, and the gold price is $2,000 an ounce, it's very attractive for miners to go out and build new projects for which they need new plants. I think there's a really good runway here of work. This was the kind of circumstance I bought GR in the past. I bought it at the cusp of a really large gold bull market when gold prices were really high and miners were making a lot of money, and GR subsequently did really, really well. And I think we're at a similar sort of stage in the cycle now where that's possible once again. They also own a little oil and gas business as well that has been performing really well in the past, but obviously earnings from that are going to collapse. They service really high quality clients like Eni and Woodside and Santos. So there's a possibility it may not fall away completely because those companies still need to service their assets. But I've kind of putting a zero next to that. And so I think the future earnings are really dependent on what happens in this mineral processing segment. Again, look, I don't own it. It's a $130 million business. It's not tiny. They've been around for a long time. The founders, this is their second go at doing this. They've run this for a long time and know exactly what they're doing. They own a big part of the business. It carries no debt. I think the downside from here is pretty low. The big trouble with this company is really that their customers tend to go bust a lot. But if you cannot make money, there's no gold mine on earth who's not making money. So I think this is a nice lowish risk opportunity to take it if you want to get exposure to that sort of higher gold price. This is a better way to do it than, in my view, than running off and buying a gold miner.
You had me at they go bust a lot.
It's kind of baked into the model. So look, they don't build the processing plant and then wait to get paid. There's progress payments all the way. it just means the accounting is really messy. So sometimes the cash flow looks terrific, and at other times it really lags profit, because profit depends on contract accounting, and cash flow comes in at stage payments. So you have to be comfortable knowing that there's always going to be a difference between those two sums, which is why, because there's a lot of discretion in the accounting, that that ownership stake is really important. The fact that the insiders own so much of it and they've got a long history of doing it well is really important. Otherwise, I wouldn't go near a business like this. I think this is an exception to a generally lousy sector.
Yeah, I guess it's basically like an infrastructure owner more so than the engineering side of the business, based on kind of what you're saying, I guess.
The difference between this, so I've called mineral resources an infrastructure business in the past, and when I pitched it, Nathan, at $13, now 23, I mentioned that they collect fees on the volumes they process. So this is actually a similar sort of business, except they relinquish ownership of the asset after they constructed it. So they only really collect a build margin, and they don't collect any ownership margin. If there was a way to make this business better, it would be actually to try and maintain ownership of the asset. But it's not really the way gold works. Gold miners like to keep a hold of their processing plants.
Just for the record, on mineral resources, I feel like the price was 17 or something, and then it went down to 13 at the bottom of the falls in March or April, and I didn't hear anything about it.
I bought it 14. All right, now the other idea that we could do one day is to do a round robin of the stocks that we own most in our portfolio. So our largest holdings, which I think would be an interesting thing. I'd love to know yours, Mickey, really. But we can consider that one day as well. If the gentlemen agree, then we might be able to do that. But for now, that is the end of our small cap special. Some interesting ideas. I didn't know what they were going to be. I think none of us sort of knew which stocks were going to be thrown up until they were. So I'm going to go off and do some more work on some of them. Mickey, thanks for joining us. How are you doing in Melbourne? Everything okay?
Well, I mean, it's it's getting to see a lot of my spare bedroom, which is, well, spending a lot of extra time with the dog as well. So
he'd love it.
It's all going great. No, it's all right. Hopefully, we'll be through this some point. But it looks like you guys are heading in that. It's kind of it's kind of interesting watching the media up in Sydney, and kind of there's a few cases, but we don't want to lock down, because I feel like it's almost the same thing that happened here, and it's just happening again. I don't know if you'll end up where we are.
Although Gladys has been saying that she doesn't want to lock in and out all the time. So I did agree with you up until about yesterday when I heard her say that. So I'm not sure we'll see a lockdown here.
Yeah, well, but I guess if the cases get to where they were here, do you think they would lock down? Because I think maybe they probably would, wouldn't they?
My view is
my life is one big lockdown anyway.
Yeah, I know. Poor Nathan, lockdown all the time, permanent lockdown. It sounds to me as though the Victorian government is far more comfortable with lockdowns, and they seem to be very controlling at the best of times, to be honest. Whereas the New South Wales government is probably a bit more reluctant to lockdown unless they really, really have to.
There is a big difference in cases as well, though. I mean, because I think we kind of started out along that path as well. And,
I don't know. Even when we had our initial lockdown, the Victorian lockdown was always harder than anywhere else in the country. And you just listen to the paternalistic Premier of Victoria, telling everyone what to do, wagging his finger. Anyway, I'm getting on my libertarian rant here, but I just think that it sounds to me as though Victoria is probably harsher than New South Wales. So I'd be surprised if we locked down here.
Well, yeah, hopefully for you guys.
Well, Nate's always locked down.
Just don't shut the Queensland border on us.
Let him make his 7 times on Experience Co.
Need people jumping out of planes.
We should send you on a field trip, actually, to do that and report back, Nathan.
I can't even get up a ladder. There's no way I'm going up.
All right. Well, I appreciate your time today. Thanks for joining us and for
No
bringing
worries.
along your ideas. And we'll have a go at maybe one day, maybe doing this the things we hold most of idea. Could be interesting. But for now, that's all from us. Thanks very much for listening.